largest bank in the world, thinks it's going to happen in the next 12 months. So let's welcome Antonio.
Does he say that for every guest?
Yeah.
No, I don't.
You don't listen to all of our meetings?
But you are.
Can I?
Look at your by the way, we have your updated picture this time.
Uh-huh.
And I think you're in the same jacket.
Maybe.
Wow.
Just
Real.
right, it's live. Yeah, exactly.
And for everyone, just a reminder, Antonio and his husband own Mamu, the restaurant. Tom is an incredible chef, and it's an incredible restaurant.
Come see us, corner of Rampart and St. Philip, and it's a good time of year to sneak in.
Yeah.
After the holidays, it's hell to get a reservation, but you can get in now.
Yeah. And they might know how to email you now.
Uh-huh.
Okay. He loves that. Okay. Talk to us. It's a crazy time, I feel like.
Yeah.
I've never been so... I just feel like I have whiplash every single day. I'm giving up on the news. Because nothing means anything anymore like it used to. I feel like you'd hear this news that we're taking a military action, and that means the price of oil is going to go up because it creates uncertainty, and it does this and it does that, and nothing's kind of following. And now we have all these specific, very weird. Everything's a one-off now.
Mm-hmm.
So maybe frame, and it's not a pro administration or anti. I think it's just this is. So kind of give us some framing of what you're thinking about for 26.
Right, and I don't know if you want me to get presentation slides or anything.
We've got the slides you wanted. We can do anything you want.
Maybe can I level set first with just talking about what happened in 2024 and 2025 to recap the markets for you. I think that's the first page of my presentation. So what you're looking at here is the almost final tally on what various markets did. The gray bar represents what it did in 2024. The colorful bars represent what they did in 2025. So the best performing asset class last year was gold. Same as 2024.
That's usually an ominous sign, right?
Not necessarily. That is one where there are very specific sort of geopolitical risks that are driving it, as well as persistent inflation. Gold is a good hedge in an inflationary environment, and it is also, to your point on administration, where there are fewer buyers of the US dollar as a reserve currency, gold acts as a alternative reserve. And so gold has been on a tear. We do actually expect that to continue. It's not my favorite asset class, but moving on to the rest of the chart, the lighter bars, what's different in 2025 versus 2024? In 2024, the United States led the way. We were the top performing equity market. Last year, almost everybody but India lapped us. And so Europe, Japan, China, elsewhere, we were one of the bottom performing equity markets, but still up 17% at the end of the year. This is a little bit dated, but 17% for the full calendar year of 2025 is a fantastic year for the stock market. And yet, if you went internationally as well, you saw it even better. So the global stock market up about 22%.
This makes 4 years in a row the S&P being up over 15%, correct?
1, 2, 3. 22 was miserable. 3, 4, 5. 3 years in a row.
3 years.
And yes, that is not typical. But when you look at this point, we are now running on a 10-year average annual return on the S&P 500 of 15%.
Which has happened how many times in history? Like never.
I don't know that. Yeah, exactly. I don't have that number for a certainty, but that is well above trend. When JP Morgan looks out over the next 10 years, our expectation for the U.S. stock market is about 8. Call it 8 to 10%. So we've been running at an above trend rate, and yet I think you'd be wrong to be overly skeptical or say, yep, I did good enough, let me get out of the stock market. You can also look, just hitting on the last two on this page, the worst performing asset class, cash. Cash is not your friend. Since our last meeting, last time I was up here, the Fed has cut rates 3 times. Cash yields are going down. It's probably going to continue to be the worst performing asset class this year. And what's different from 24 to 25 is now even bonds are beating cash. So that is also something that we expect to do moving forward.
And when you say cash, you mean cash, treasuries, CDs?
Anything short-term, less than a year, Yeah. Whether it's a money market fund or a CD or a short-term bond or cash holdings. Mm-hmm. And what this does is this motivates investors to do something. So your clients who have been sitting on cash, and I said this before, but now it's actually live because we've seen those Fed rate cuts, are going to be a little bit more motivated to do something with their cash. Because it felt just fine to sit on your cash when it paid you 5%. And then last year it was paying you 4%. And now it's paying you 3%. And eventually you're going to wake up and say, I should do something. And so
I think this has been a big problem for us, actually. And the stock market's another problem for us. Aside from it being expensive to get a loan, you're looking at you're probably going to, if you're investing, you're probably going to buy a building that needs new tenants or has no tenant, needs tenants, and then needs some kind of money invested in it to reposition the asset. So it needs a renovation, it needs something like that. And if you're an investor and you say, man, I could take all this risk in New Orleans where there's hurricanes and insurance and high interest rates, or I can just go buy an S&P index fund and make 18%, it's really hard to justify that to a client.
Right.
Like smart investors are like, I'll just leave my money with Antonio. And so we're on. I think that's been a challenge for us.
Okay, I got a chart for that too. But
let's talk about it. Let's go there.
You want to go? It's all the way at the end. So if you don't mind going.
How far?
I think it might.
Oh, was it at the end of the deck, or was it the end of the ones you wanted to see?
Before the appendix, just.
Okay.
I don't know.
Did we actually link to the full deck, Sean?
That's okay. Let's move one forward. I'll hit there on the end.
Yeah.
Let me try to go in order as best as I can.
Yeah.
So what's going on? We concluded our last meeting with Jeffrey. You were asking me a question about like how can the Fed cut rates if inflation's not tamed yet, and what's going on. And my answer was employment, because the Fed has a dual mandate, and their decision to cut rates is based on taming inflation, bringing inflation down when it's too high, and managing unemployment. When unemployment starts to spike, you cut rates. That incentivizes people to hire and do more economic activity. And so what we saw and what has been working out that personally I was very worried about 6 months ago is we do seem to be landing this plane very carefully on the unemployment picture. Unemployment currently stands at 4.6%, which is not a huge spike up, but it's still higher than the Fed's mandate of 4%. But what you're seeing in this chart on the far left is those payroll numbers the trend is down, right? So what's kind of happening is there are fewer new jobs being added, fewer people being hired, but also not a lot of people being fired, and very importantly, almost no immigration. So the combination of policies that I was worried about is that if our immigration policy led to no new employees, that if our payrolls continued to run at the rates that they were last year or the year prior, that we would end up with not enough people to work, unemployment would stay super low, wages would spike, inflation would go crazy. Luckily, that does not seem to be what happened. We are sort of landing this in a way that unemployment is a little bit high but not untenable, and inflation is my middle chart here, is tame but not going to reach the 2% target. So our outlook for this year is that inflation is going to stay between the 2.5% and 3% range over the course of this year. You can see the three lines that you're looking at in the middle chart are goods, services, and then the core. So the headline number is the orange dotted line. That's the sort of main inflation number that folks look at, core CPI. Services have been driving inflation in 24 and 25. People really freak out when core goods have inflation. So that dark blue line, when that really spiked and the price of eggs was crazy, that when goods inflation goes crazy, people really feel it because the things on the shelf that they're looking at or on Amazon that they're shopping for look more expensive. So goods inflation has more of a psychiatric effect, where services inflation is like the price of your airline ticket. Who can ever tell how airline pricing really works? Or your dining out experiences, which maybe you don't pay as close attention to. And so net, inflation is a little higher than we want it to be. Unemployment is a little higher than we want it to be. And the far right-hand chart leads us to mean more cutting. So as I said, we've seen 3 cuts already. The Fed funds rate is between 3.5% and 3.75%. That is where your cash rates are too. And that has caused a little bit of economic activity to pick up. So what we're saying on this chart here is that last year there was also a pause in new jobs added because of the whole Liberation Day tariff news. It took us months to figure out how that was going to pan out and what that was going to mean. And a lot of companies just paused on their payroll plans. If you were planning to hire or move somebody, you just paused. And so as that picture has sort of clarified, and what we're seeing in our themes for this year is a tremendous amount of activity, specifically around AI, that has led to new payroll, new jobs. So we think that those labor numbers have sort of bottomed. Like from here, they should get better as we head into 2025. So hopefully that manages the unemployment picture slightly.
But that would mean slowing down any air cover to lower rates even further.
Correct, which is why we're predicting one or two more rate cuts early this year, and then probably a pause.
So maybe 50 basis points left, 2 quarter-point cuts, and that's that.
I'll say 25 basis points, but sure, could be 2.
But that's based on logic and not pressure from
Well,
our president.
Correct, it could be based. So first off, just to hit that point, Jay Powell's term ends. We're going to have a new Fed chair.
April,
President
right?
is correct, is influential in that pick. The Fed is an independent institution. There are 12 Fed governors who vote on the FOMC committee to decide on rates. Changing the head is like changing the guy who sets the agenda, but you can't change the votes. And the Fed is intentionally designed as an institution that's difficult to be manipulated. And so whether or not you put your guy and you get your head and you get one new governor, it's going to be a little harder than that to change 12 votes. So we still have some faith in Fed independence.
I think an interesting analogy is the Supreme Court.
Yeah.
For years, each side tried to put people that were purists, ideal, purists to a certain idea on the Supreme Court, and then they got on the Supreme Court and then they like moderated out. And then they had to go and they had to wait till see how they came out the womb, and then if they didn't have if you wanted to be appointed by a Republican president now to be a Republican jurist, you basically have to have a pro-life stance from the time you're born, right? And never write a paper ever as a lawyer that says anything but. And they're like looking for that purity. This is the first time this is being done. It's a potential more political pick.
Right. I'm not saying you can't undermine Fed independence, but our view is that's not something that's going to happen this year, right? It's not going to happen with like one pick or one. So we, as we're setting our outlook for likely rate cuts and things like that, the Fed is still an independent body. We will see how this works out, and we still have faith that that's going to be the case.
Love the optimism.
I think we've got to remember that all these news cycles are flat out like manipulative.
Yeah.
And so it's nice to kind of get away from it, zoom out, and then go look at
Look at the data.
Look at what's actually happening. So Antonio tells us all the time, when the economy goes, down, we're the first ones to get the stimulus, to feel the stimulus after they put it in, right? And then when they take it out, we're the first people to feel the takeout. And really, real estate's been one of the few industries that's felt this misery of 3 years.
More than others.
Right?
Yes.
More than others.
You guys have been the canary in the coal mine, and you usually are.
And so
outside into our industry too is like made that feel even worse.
yeah, I think, Cody, can you move that table, if you don't mind, just down to the ground?
And
I think that's so my question kind of to bring that back is, we've got 50 basis points left maybe of rate cuts, you said.
Unemployment has probably, or
in a
payroll
Goldilocks
numbers,
situation there?
Yeah, payroll has probably seen some of our worst reports maybe in January, February here. We were worried about things, to your point. We may never get the October 2025 payroll data. That is just something
Probably
that
won't.
Trump administration, it's just never going to happen. And so what gives us a lot of concern is when some of this data and things that are coming out, yes, we're dependent on the DEA to get that data. And if they don't release that data, what are we flying this plane with? And so data will continue. Some of our worst reports may be in January, February this year, but we do expect that there's a tailwind, that labor will get better. 1 to 2 more Fed rate cuts. And then maybe the most important thing, driving this is CapEx spending from companies, businesses buying stuff. is set to drive the economy in 2026. So we are predicting a 2.5-ish% GDP growth rate. Fourth quarter of 2025 was at 4.3%, so that's slower than we've been going, but still, the question I get most often is this whole AI thing enough to drive the economy?
Is that a good next slide?
Yeah, good next slide. And so here's the three things that we're focused on for this year. AI, fragmentation, inflation. Those are the 3 points you got to remember. So the AI revolution, whether you want that sort of hype in your naming, is very real. Since 2022, S&P 500 CapEx spending has been $1.3 trillion in this data center semiconductor build-out. For reference, that is in 2025 alone, that was close to 2% of our overall GDP. Oh yeah, you threw this one in here. Here's your reference, and this is maybe my favorite chart to help people explain why this is a big deal. The black bar is tech CapEx, like spending on real estate, but our own example is the Hyperion the Hyperion data center that's in North Louisiana that they're eventually planning to build out to be the size of Manhattan. It is that kind of CapEx spending represents about 2% of GDP. For reference, the 1930s public works projects that gave us the Golden Gate Bridge and the Hoover Dam and all these other things were, less than 0.5%. If you were to take that plus the Manhattan Project, plus the electricity grid build out, plus the entire interstate highway system that we built out in the 60s, like stack all of those next to each other, and that gets you close to what you barely beat what we're doing. So this is huge, and it's a little bit strange and doesn't quite feel real to us because a lot of it is happening in Ruston, Louisiana, or like not immediately in front of your face. But it is happening, and it's a very powerful trend. So if you want to go back one for me. Sure. So the AI build-out is real, and we gave all these with consider, like what would you invest in if that's a theme that you're worried about or want to invest in. Hyperscalers are your companies like Meta, Amazon, Google. Those are the guys who are building, and Microsoft, who are building and benefiting from the AI models. Semiconductors are your TSMC and your NVIDIA, and now I would throw in all your memory companies who are building the actual chips. Power is a huge bottleneck. Our very own Michael Semblis put out a piece to start this year that is called Smothering Heights. It is a tough read, but it is maybe one of those eye-opening. You watched the webcast, right? So watch the podcast version, get it done in 20 minutes, and you don't have to read anything. It is very important to understand the amount of money that's going into this sector is full of challenges. There are bottlenecks at every left turn in terms of getting the power, getting the chips, getting the construction labor, getting everything done. And so that is going to create a tremendous amount of market opportunities because it's not a one-year thing. AI data center build-out is going to continue in pretty heavy rotation until about 2030, and then we'll be reevaluating. But companies have already committed to building projects that will go on for several years, right? Hyperion's not going to get done in 12 months. So the second theme, think fragmentation, not globalization. So the word of the day for the past 2 decades has been globalization, global trade, finding the cheapest source where you could build anything. The new world order, for lack of a better terminology, does include these sort of spheres of influence where people are thinking about that friend-shoring, onshoring, creating an environment where the countries want to make sure that they have access to power, energy, cybersecurity, food, water, like those goods. We are now making sure that we're getting all of those things from friendly countries.
Pharmaceuticals, rare earths.
Pharmaceuticals, rare earths, the list go on. Like you want to be able to get the
iPhone.
critical things that ensure your citizens' quality of life. You want to make sure you're getting those from friendly sources. And so that's what we're calling that is fragmentation, not globalization. And so that is why gold has been a beneficiary of that sort of breakdown of the mega globalized world trade. Global industrial companies, security companies, we're going to talk about European defense spending, but national champions, which are some of like those companies like NVIDIA that lead their respective fields. Natural resources, metals and mining companies have gone absolutely haywire this year as the U.S. tries to figure out a way to get our own rare earths and the like. So,
A lot of rare earths in Denmark. I mean, in Denmark, in
Greenland.
Greenland, owned by Denmark.
There's a lot of other, yes,
Yeah.
agreed. A lot of other sources.
Well, I don't want to. Yeah, I know I wasn't trying to get political, but if you start looking at all these things, right? Venezuela was potentially a brick outpost right below us. It's almost similar to like Cuba in the 60s. You know,
So
we're
Sembus
trying to avoid
also,
right.
he put out a piece in Venezuela as soon as that happened as well. From what we can tell, this was not an out of left field thing. There have been advisors in the Pentagon that have been concerned about Venezuela, who has had partnerships with Russia and China to build drone strike programs that had the capacity to reach Florida. And it was just, again, it's been a security concern for quite some time, whether or not the oil grab is the other motivator, or if Maduro simply made Trump mad. I don't like whether that may have been whatever that on the timing, but this has been a known security risk and something else that for many years.
Wasn't trying to get you in the weeds on that, but let's go to rates, because I think that's kind of the story. We've seen.
Did you steal these from me, or these?
No, these are national averages.
Yeah, that's not mine.
I'm going to put yours up in a second.
Okay.
That we normally do because we're condensing out the rates section of the meeting today. I mean, look at what the national average is right now from Mortgage News Daily. We might see, the 10-year is what drives rates, right? Not the Fed funds, y'all know that. The 10-year spread to the 30-year mortgage is narrower than it's been in a long time. So that could mean a couple of things. Number one, confidence in the market, and disagree with me if you want. But number two, it could also be that they're baking in the next 50 basis points of cuts from the Fed. And that is so that could be a part of the narrowing.
Confidence and lower, but so that spread.
The spread's narrowing.
That spread narrows when people have more confidence about where the 10-year will be. So that Fed funds, when they cut rates, that determines the short end of the curve. So like your cash rates, your line of credit rates that you might use for a renovation. The 30-year is based on how volatile is the 10-year. So right now the 10-year is at 4.14, 4.15. Our view for this year is that it's going to stick around 4.3%, so call it 4.25 to 4.5. But not a huge amount of volatility, but if it does move, it's more likely to move up.
Yeah.
So not a huge amount of relief in the cards for 30-year mortgage rates.
So that's where I was going. Is we're probably within a quarter point, or give some jitter to where we're going to be for the rest of the year. Is my guess.
30-year.
Yeah,
you got my rates up here somewhere?
We're going to get there. Man, front running me. Okay, so look at Antonio's rates. And I think this is really interesting because when I've been looking, I bug Antonio all the time for this chart. And what you've seen in the past is this is basically like a flat line down. That was
weird. There was a meeting. Right, I don't remember if it was 1 year ago or two, and I came and sat
about
in front
2
of
years
yours,
ago.
And I put this chart in front of you all, and when you looked down from the 3-year down to the 30-year, it was the same. It didn't matter which product you picked. It was like the same rate all around, and that's very strange, right? That's not supposed to be.
So ignore the APR columns. That's required by law for them to put. They base on the size of the relationship that they have with their clients. So you can pick any column. Just you look one column on the rate straight down. So let's look at the best looking one for their clients that have 25 million of assets with the bank or more. So you're being rewarded for shorter durations, finally, which there used to only be maybe a quarter point of reward.
Now you're a full
between the 30-year fixed and the 3-year ARM.
Right. Now you've got a full percentage point difference. Well, I guess that product on the bottom is a little weird, but I'll touch on that.
That's a JP Morgan product. But I think that's interesting to see. Some clients might have the point of view that rates are going to go down, and they can save a little money potentially. I think there's another thing. Why is everyone? What phase of life are we in as a buyer? Because we know most people move in 7 to 10 years.
Right.
As New Orleanians. So
nationally. That's the stat.
Well,
the average
it's actually
homeowner-
5 to 7. I think it's more like
7
5 to
years
7
is the
across
number
the
of
country,
years.
and New Orleans is a little more like
10.
like 7 to 10.
Yeah.
So if you start playing those odds, and especially if people are coming into having children or getting job advancement, that sort of thing, they're going to be moving sooner than 7 to 10 years.
Right.
So this is an opportunity for them to knock some money off potentially and not be in a 30-year product.
Correct. And again, what are the odds that 7 to 10 years from now or 5 to 10 years from now rates look worse, right? So in any of these rates or the way that we talk about a lot of these ARM products, this is pretty standard across the industry, is when you look at what says a 3-year/6-month ARM, that is 3 years of having a fixed rate on a 30-year mortgage. The loan is still yours for 30 years. You don't have to do, there's no balloon payment or anything. You don't have to do anything in 3 years, but after 3 years, your interest rate may float. So on those ARM products, it's important to remember. So
This is a residential product. That's
on
not
a
how
residential
commercial. That's not how
product,
commercial rate loans work. This is
Right.
a residential.
home owner product, but 3 years of fixed rate, and then it'll adjust every 6 months after that. And you have every 6 months to say, is this working for me? Can I refinance for better, etc. So it's still a 30-year loan. You're still going to live in your house, but whether or not it's the best rate for you may be more interesting.
So I think we can do a lot here. My big takeaway is we can do a lot with these rates. We can see a lot of real estate traded. And Cody made a very nice chart. This is not JP Morgan's. This is ours. We took the Fed funds rate, okay, which is in blue, since 2020-ish. Yeah. And then we took the NOMAR data of units sold, and we annualized that data. So as rates fall, what's been happening? Our units have been going up. And it's amazing. Look how fast the unit pop was. Look how fast we went up. As the news was happening, as the Fed was lowering, we were just seeing those units pop right up. And because it's annualized, there's a delay in the data. So it was actually, the news was triggering people to want to buy more homes. Does that make sense? So these are just some good mental things to remember. And so I would not shy away from talking about the news of potentially 2 more rate cuts this year, and that's what's priced into the bond market, is that prediction. This obviously means something to consumers, is my point.
I think you may have said the colors backwards.
I think I'm just kind of lost by your example because the red line is going down. Units seems to be going down, not up.
Look in 23.
Blue is the units.
Yeah.
Wait.
I was like,
Sorry, I did say it the wrong way. Thank you.
so the blue is the home.
Yeah.
Blue is the
Yeah.
number of units that is going down. Now it's going back up a little bit.
ChatGPT forgot to add the legend 2 minutes before we added this.
This was a fast ad. I
slide
apologize.
deck.
So can we bring this down to like a local level? And
This is a local data, and I'm trying to prove to you that this national news means something to your consumers. And so when we're talking about people and getting them off the fence about buying, is now a good time to buy, we know that this has an effect on their psyche.
Well, I mean,
what kind of effect, like, I would love to see the numbers with the investment side of the local business now with all of everything that's happened in the last month and a half, 2 months. Seriously, like, the whole repercussions of what's happened here locally. I'm really anxious to see what happens.
I think that it's going to be interesting. I haven't seen anyone pulled over lately on my way to work by ICE. I'm seeing.
because they're in Chicago.
Well, maybe. We don't know, right? They don't say that they're totally out of the city. But, I've seen construction projects, like the renovation across the street from my house is seeing signs of life again. Not a lot, but it's, so everyone's data is local. I think it's just starting, like before, we hadn't seen anyone there since Thanksgiving Day. It's like Thanksgiving Day happened and then they shut down.
Yep.
So we'll see what all that means. We need people confident that they can do a renovation to buy a house. I mean, that's a lot of people do improvement work.
Labor in New Orleans.
Right.
For any trade you're in.
Right. So, anyway, a couple questions for Antonio, or do you have any final thoughts you want to share before we do?
No, those are the 3 main drivers. I'm happy to answer any questions if you guys have them.
I have a quick question.
Sure.
Are y'all seeing any upticks in like foreclosures? Or
Not major. So we saw a bit of an uptick in subprime auto lending, but not home, not meaningful.
Yeah, I think one local data point there is Crescent Bank sold. Crescent Bank, owned by the Solomon family. What they primarily do is subprime auto loans. So financing used cars at 12 to 17%, and they sold that portfolio off. So and they're out of the business as a family locally. So the fact that they were ready to get out was like and just talking to them a little bit told me a few
Homes
things.
tend to not be the first place you see it. You see credit card defaults pick up first. You see subprime auto pick up first, and then homes are later if things get really bad. From all the economic indicators that I'm trying to show you around labor and around inflation, around all those things, we don't expect to see those home default rates pick up.
Why are there so many headlines about the AI being a bust?
Yeah, you're right to. Anytime something gets this much hype and this much money thrown at it, I had a whole rest of the section on this presentation on the reasons why we don't think AI is a bust. There are some signs that look concerning. So to me, the most concerning signs are when you see AI companies investing in their own supply chain. So NVIDIA is my example, and you see them investing in both the people who produce chips for them as well as the people who buy chips from them. So
Oracle announces they're building a data center.
right.
And then they're going to do a deal with NVIDIA to buy the chips. And then
NVIDIA is investing and giving Oracle the money to buy the chips
right,
back
and then
from
they're
NVIDIA.
doing a loan or a big bond to that company, and they're all circularly investing in each other. They did this. We saw this back in the dot-com boom, and it was kind of towards the end of the dot-com boom. We saw everyone was investing in each other, and it made the implosion worse.
So that is the area for concern. The other thing that is of concern is that's different than the dot-com boom is that the AI boom has represented immediate revenue generation. When you put money in the data centers and these things come online, they're able to turn it into dollars and profits immediately. That was not the case when people were investing speculative on pets.com and it was pay per click or whatever, and there was like no actual revenue there. So when the deals actually result in immediate revenue, there's less of a concern on that circular monetary transaction. There's also Q4 2025 had a tremendous amount of debt issuance from these tech companies that don't normally issue debt. Now, a couple different examples. I'll use Oracle and Meta, which is Facebook. Oracle now stands out as a company that's taken on a tremendous amount of debt to pursue this data center build out. And their sort of debt to profit ratio is out of whack. Accordingly, their stock fell like 43% when the market realized that. It popped when people realized they were getting into the trade, and it fell when people realized how much debt they were going to have to take on to do that. So they were being punished appropriately for taking on too much debt. Other companies like Meta, and Mark Zuckerberg's been out there saying, like, I can't afford not to win this race. Like, I'm not worried about the revenue. I'm putting money into it. His debt to profit ratio now stands at 63%, 0.63. That's up. It used to be like 0, right? But the S&P 500 average is 200%. And so he's still a quarter of what most companies in the S&P 500 are able to sustain. So I think people are worried about that debt issuance. Amazon, Microsoft, all these guys have done a debt issuance explicitly in the fourth quarter of 2025, right at the end of the year last year. And so the market's got a little skittish about the amount of debt these guys are taking on. But when we paused, and again in Michael Sembl's piece, if you have an interest to look at it, and put that in perspective of what we think they can support, we're not concerned.
We'll give you, on this slide, we'll put a link to the full presentation they give, his full slide deck. But I think there's a really great reminder of the tech bubble was everywhere you went, somebody was giving you a stock tip. And that's not happening. We haven't gotten there. And I think that is because there's subscription revenue that immediately comes in. I mean, we're paying more subscription revenue for software AI products, and we're a small company, but we rely on them, and we use them every day.
Right.
So there's a difference there, and I think there's also a difference in that There's multiple legs of this build-out that they're still doing.
I had
and
a chart on that,
And you all have
too.
a great chart on that. So
So-
go look in the presentation. It's worthwhile.
It is worthwhile. Just to say the short version, we think there's sort of 4 phases of this AI build-out. We are in the second phase, which is the data center physical infrastructure phase. The third phase will be producing the models that are most useful. And then the fourth phase is the phase where consumers and end users' lives sort of change. That is the beneficiary change, where Walmart's able to better monitor and sell and monetize their items because they can do more with AI, tracking of customers in stores or security monitoring or whatever the case may be. So the fourth phase is the end user phase, where most of this is like really going to come home for the average consumer. Right now, it's still all happening in these huge data center out in Ruston.
It's not Ruston,
Bulldozers.
just so you know.
Near.
It's closer to Monroe. It's about 10 miles outside of Monroe. It's only about 45 minutes away.
Messing up your hunting camp. Okay.
That's why.
Lori, and then we're gonna.
I'm sorry, I'm picking on
Lana, you
Rustin.
have a question too?
Antonio, what is your thoughts on cryptocurrency and investing in cryptocurrency?
Yeah,
Glad
so
someone asked.
Crypto has been a beneficiary for the same reason as gold, as people are looking for a store of value outside of the U.S. dollar. The more that it has administration support and we get some sort of regulation around it, the brighter the future looks. Personally, not a fan, just because it offers no yield and it's not been well studied in terms of its correlation to other asset classes. Right now, crypto has just acted as a higher beta version of stocks, meaning when stocks sell off, crypto sells off harder, which is not tremendously additive to my client portfolios. And so personally, I'm not using it. JP Morgan does not use it or recommend on it in the portfolios that we manage. But it has been a beneficiary both of the administration's current policies as well as from this international trend of looking for other stores of value.
You said that in a very nice, academic, clean way.
I loved it.
I want to, yeah, I did too. All the crypto, I get in these crypto fights a lot. Like, y'all are so behind that you can't buy a house with crypto and all this stuff. And I've got to like listen these people out and just let them go. Crypto was promised to be like a digital version of gold or a hedge against everything else. And it's not, like, there's never...
It's not behaving that way.
It's never behaved that way. Like, maybe for a short period of time it has, but in the time we've had Bitcoin, it's just not done that. And then it falls when all the people would say that it should be a protected asset.
So I don't think of it as an investment, but it is really cool technology. Both of us should care a lot about blockchain technology. The day that you guys can tie real estate title to a coin and trade without a title attorney, the whole real estate industry is changing on its head. For me, I can't wait till stocks get tied to some sort of blockchain technology, because the whole ACAT system of trying to move a stock from one institution to another it's a painful, terrible experience. So blockchain technology is also like really cool and really powerful and can do a lot of things with it. JP Morgan does invest in blockchain. We do have our own tradable assets that we use for like bond issuance and all sorts of cool things. But crypto, meaning like you should buy Bitcoin, is not a part of our portfolio.
Shiba coin.
So you can invest in
I'm joking about that, but I think that's the argument. And look, there's a lot of people who say they've made a lot of money on it, and it's hard to argue with them.
Right.
I just look at it as a high risk, interesting asset.
Yeah.
Lana,
I
you
have a
want?
question.
Yes, ma'am.
Going back to the AI and the data center build out, what happens to the economy when we run out of water?
When we run out of water.
power.
Correct.
And so power and water, both huge demands here. And so what we're looking at, and again in Michael Sembl's piece, he addresses both of these, but the incremental benefit of NVIDIA's 2026 chips that are coming out are significantly, they just released, and actually a whole bunch of companies sold off in the cooling industry today because they said it requires 40% less
Yeah, training.
chilling.
And all that.
Less chilling specifically, so it requires less cooling, less... The new chip. And so every new chip that comes out that requires less power, less water, becomes more tenable when we do the calculations of how much needs to get built out. A lot of these data centers are also required to be at least, I forget the number, it's 90-something, 99%, it's recycling the same amount of water. So it's not, it does use a tremendous amount of water, but think of it more of that water is taken in one time. It has to be cleaned, it has to be purified, it has to be maintained at a certain temperature, and that water is then recycled within these plants. So these plants do not consume water, or I guess it's a one-time consumption of water, but then once that water has been consumed, it is by and large recycled. And so the hope is, or the plan is, to build chips that are efficient enough that it does not require.
Energy is the concern.
Sure, there's huge reasons.
I mean, that's going to affect.
Electricity is huge. So historically, there's a problem. OpenAI is saying that they need 30 gigawatts of power by 2030 to power their training modules.
And let's talk about, let's talk about the Chinese though.
Hang on for 1 second. 30 gigawatts of power. One average nuclear turbine is 1 gigawatt of power. Since 2013, the United States has built 2 turbines, 2 power plants, right? So now we're talking about needing, what's that?
But they've also closed down.
And they have, correct. And so
none of this makes any sense to me at all.
of where we're going to get the power?
Yeah.
So there are, and the other really important thing on turbines, nuclear is not the only way. I'm using a nuclear turbine as an example to help you understand like the sheer number that we would need to build. China has built 13 nuclear turbines in the same amount of time. We're still, and that is a 12-year period. We're talking about 30 in the next 5. So like what is doable is like we're not going to get this all from one source. We're not going to do this all in one way. There are also 3 major producers of turbines. There's all sorts of bottlenecks in this process. Producers of turbines are GE Vernova here in the United States, Mitsubishi in Japan, and Siemens in Europe. And those are like the 3 guys who build natural gas turbines or any sort of turbine at the scale that we need for power generations. And all 3 CEOs of all of those companies had said, no, we watched Charlie Brown and Peanuts. We know Lucy with the football. We're not going to ramp up our production of turbines only for this whole thing to not happen. We'll take our super fat profit margins building exactly as many turbines as we want to build, and they're going to be a bottleneck, right? So,
which is not a bad thing for Lana's interest, because if you look at what we've done with China, where I was taking that, was like we've just said we're not shipping Blackwell, the best NVIDIA GPUs to China. Mm-hmm. So what have they done? They've figured out how to make their own LLM models with older chips that go slower. They're a lot lighter weight, that use less water and energy, and get like 80% the results. So our like trade policy, until just recently, was forcing someone else to get smarter. And I think as more people come into this field and there's more and these big fat profit margins, hogs usually get slaughtered. That's capitalism.
The bad news on your question, and tying on to Jeffrey's point, Michael Semblus again does a great analysis on the power of a Huawei chip versus an NVIDIA chip. Okay, and they're comparing the next generation of each, the 2026 chips.
The Chinese chip maker versus
Chinese
US.
chip maker versus U.S. chip. Who's the best chip you can make, the highest end one they offer? The NVIDIA chip still has a pretty significant moat with almost 4 times the compute and 40% of the power consumption. And so there's a pretty big moat behind how good NVIDIA chips are versus how good Huawei chips are. The problem is that the Chinese method of tackling the problem is just like, well, we'll just build more of ours, right? We'll just build bigger, whatever it is.
We'll wait till the US comes
problem
out with it, and then we'll copy, and then we'll get smarter.
Well, no, they're just gonna throw more resources at it, and if our chip's only 40% as good, we'll just build 3 times as many. And so, to your point on water consumption and usage, I'm more concerned about how that build-out looks because of their approach to data centers versus ours. We'll see.
Go on real quick, because then we got to go.
Okay. So it seems as though, and tell me if I'm wrong, that that inflation is becoming less of a consideration when, as far as like interest rates goes and the Fed decisions. Mm-hmm. And so, like,
unless it spikes again.
Unless it spikes again. So, like, if you have a client with, like, if you you have clients with large cash reserves, let's say 5 million, 10 million, whatever the number is, and the performance of cash, how are you directing them?
Yeah. Calling them all the time. So we're talking about, first off, at least buying bonds.
If they have 5 million, 10 million cash, yes, call them all the time.
Yeah, we do. But the first baby step that I can call somebody and say, look, if you at least want to keep your yield in the 4s and want to keep getting what you used to get in cash, we can buy some super safe bonds and earn the same amount. The other thing we can do is look into other yielding assets. That's where we get into real estate, infrastructure, other types of assets that have stable cash flows associated with them that are better inflation hedges. Real estate, again, that is part of the reason that it's in that chart somewhere, but it's the place that we go when inflation is a concern for clients who are interested in yield. So when cash pays you less and you want an inflation-adjusted source of yield, rental property.
Yep.
Or whatever the other infrastructure build out, we do it through funds and national vehicles and all that. You could do it either way.
All right, Antonio, thank you so much for being here. We really appreciate it.
Appreciate it.
Okay, that would be like a whole meeting, but we have one more guest that's kind of important. Y'all may have met her. She's been around a little bit. Everybody welcome Cammie Thompson. Hello, Cammie.
How's it going?
So great to have you here. So, I think it'd be weird if we didn't address the elephant in the room. That's the. Wait, did we not give her a microphone? Oh my gosh!
Okay, that's what I was wondering.
Hold, take Cody's.
Oh, there we
This
go.
is very cool.
There's a man in the audience holding a phone up recording, and I think we should disclose that that's your proud father.
It is my
Fletcher.
dad.
Over there.
there.
So, I've heard, Nichelle and I have known each other a while, even before she was at Keller Williams New Orleans, and we would talk on the phone and have these conversations, and she'd say, my daughter is a transaction coordinator for this big team in Baton Rouge. And, I'd heard that over the years, and then we kind of started.
Then you really heard it?
The timing worked out. Let's just put it that way. And I said, I'd really like to meet Cammie. And Cammie and I met, and I got to know you, and I realized you were exactly what we've been looking for a long time. And so I wanted you all to really meet Cammie, and Cammie, tell us about yourself and growing up in New Orleans and all those things. And
So I'm Cammie. I'm born and raised here in New Orleans. I went to McGee from first grade all the way through. Then I went to Loyola Chicago. It was a little, go Blurs. It was a little cold. So then came back to LSU. So go Tigers. And then basically after that, I did a lot of my work in customer service-based jobs. So whether it was me being a front desk person and greeting customers and things like that, or being a bartender, I've done a lot where, I've worked with quite literally every group and category of people. And then from there, I ended up moving to Baton Rouge and working for the W Group. And while there, I was their transaction coordinator. One of the biggest things there was basically everybody in that office had to use me. Like, that was the process. There was no, if you want to. So I got pretty comfortable working on, several different types of deals. I was managing around, 60 pending files a month.
on average.
On average. Getting around 6 deals per week, and that would be from under contract all the way through to closing. Then I slowly started working into handling listing coordination, so before we're even putting it live on MLS, all that things. So I did a bit of everything and kind of came up with some processes that I feel really help streamline agents' businesses, and especially, as y'all probably know, every agent likes to kind of do their own thing and what fits. But I think with me, I was able to figure out something that's simple in the sense of it's nothing new, it's nothing crazy, but it's effective, because basically I'm taking away all that like busy work that's keeping you from going out and like making more revenue, meeting new clients, having a personal life because you have to duck out of dinner to draft an addendum and things like that. So just something where it's like you don't have to be the admin of your career. Like I'm here to take a bunch of those little things off your plate that could normally fall through the cracks and making sure those little things don't build up into like a big fire that we can't put out.
Yeah, I think that's love that. So what y'all have heard me talk a lot about, I think teams have had to refigure a lot in this economy, right? Internet leads broke. And why did you have a team in the first place? You had a team because the leader of the team had a surplus of leads and things that they were, and opportunities that they were missing out on, so they needed more people to give them to, and they wanted to get margin on that. And I remember, 10 plus years ago, we were told that, when you get into real estate, you're on this treadmill to get your first hire, which is admin one. And if you read the red book, it outlines what the perfect process is for that. But I don't think any of us want to live on a treadmill anymore. And I think we've all seen a downturn in the economy enough times now that we're tired of we know we don't want to manage people. We know we don't want to have the risk of someone's salary on our books. And maybe our business isn't quite there where we feel comfortable with that. And we're trying to rebuild after some downturn. So how can this brokerage help you and give you leverage, and this apply to people at every level? And that's where Cami comes in. So if you're a brand new agent, we're about to roll out some rules. We're continuing to make it hard, more and more standards for joining this office. But one of them is that minimum your first 4 transactions, you need to use Cami. That's a risk mitigation issue. But if you're a good agent, or from production level, middle agent, top agent, whatever, I can give you this whole argument of why you should be outsourcing this part. You see, whenever I'm in a transaction and I end up in a pickle, I usually could have fixed that problem a week ago if I was proactive instead of reactive. And the reason I wasn't proactive was because I didn't have the time, because I was dealing with other fires. And I was in a loop of being stuck. We want to get you out of this loop. We want your clients to have the best client experience that any client gets in this business. Lauren and I think the whole leadership team believe that the key to us moving forward and building our businesses together is that clients see our value more than ever, and they are expecting us to show it more and more. So if you don't have leverage that can adapt with your level of business that's at no risk to you, you're really missing out, and it's really putting you at a disadvantage. So we're in beta, okay? We're going to treat this like software people talk. We're in beta through Mardi Gras is the timing. And we are giving every agent the opportunity to get a free transaction with Cami, their first one between now and Mardi Gras. You just got to open the file between now and Mardi Gras, okay? Good deal? Mm-hmm. All right, so let's talk about what these look like. We're talking about 2 service levels, premium and white glove. And we've kind of chunked this up. This is all downloadable. We're going to have to move a little faster than I was hoping just because of the time. But when we get into white glove, we're even adding some marketing things on there. Like Cami's going to call your clients and set up a Zoom with them and ask them questions and kind of give them a short little interview after the transaction, mm-hmm. right? And record it and get their permission to use that so that you can use it on social media and you can use their quotes. Wouldn't that be nice? But who has time to do that stuff now, right? And just think if that's happening through through every step of the transaction. Mm-hmm. How often are you going to touch a file?
At least every day, minimum.
So if it's under contract, you're going through mm-hmm. that file, checking deadlines, doing everything once a day. That's what you did with the W group.
Yes.
So, and again, we're going to email this out. More and more of this is coming out. This is not like these third-party services where you really still have to email her all these things and double data entry and still put in command. She will take over command. The one thing we won't do, we'll that's not included in the price is writing the contract or writing the or negotiating the PIR or sitting in inspections. There's reasons for that, but those services can be added on. If you have things you want added on, please tell us. Like we said, we're in beta. We're working these things out. They're all subject to change. We are really, we've gone through, we've tested a lot of pricing, like what other third-party services charge that don't do the same thing, what Kimberly was charging, who's, by the way, Kimberly backed out on her own away from us. So we wanted somebody that is a W-2 employee here, that's on the leadership team, that's in the huddle every day, that's really involved in the office and on site. So we think for the premium service, $385 a transaction, whether it's buyer or seller, is a great deal, especially for that long list of things you get. And then for white glove, $550. What did I leave out?
I think also like you said, I'll be here every day, Monday through Friday. I'm currently like in the library right now, so after, if you want to come in and just ask more questions, I can show you like more detailed list of everything. Just talk to me. And I think also like a big thing for me is like the process that I've come up with. I've seen it work on a variety of different agents, and I believe it would work for y'all. So I know that like sometimes we're like, oh, maybe this, maybe, like, you know what I mean? Like, yeah. It's still beta. We're still tweaking things. But
you're not recreating the wheel here. You're refining a past process and adapting it to New Orleans market. Mm-hmm. And I think this is going to be more communication than you or your client has ever seen. You're CC'd on everything. Mm-hmm. Things will not fall through the cracks. Oh, yeah, and she's going to handle command for you and all those things. And
huge benefit, and I think you all can just see her demeanor, and she's so personable, and I think it's going to be, you'll all be proud to have her interfacing with your clients. We're very excited.
Any big questions here? Or?
And how wonderful is that for Holly?
Oh, I think, and MJ and Clayton, and I think this is a big unlock for a lot of us. Yeah. I mean, I think it's a big deal that if you just tell, if you're taking a listing, now you've got an admin without going and finding an admin. Ask David how hard it is to go find an assistant. Okay, and keep them. So you take a listing, you give the basic info. And all of a sudden, GoPost is going to handle, she can coordinate GoPost putting the sign out. The photo is being taken. We still want you there. You should be at your photos, everyone. I really believe that. David, I know you disagree. But I generally think the people should be working there to stage photos, but she'll handle the appointments. Every little thing like that, it doesn't sound like a lot, but then we know when we add it all up, it takes time to get a listing online. And so you've got that leverage now on a one price that you can predict. I think that's really
in-house.
And it's in-house. So anyway, that's where we are. We're really excited, Cammie. I'm so happy to have you on board. All right. So you can start that now. Okay, we've got a couple things.